Good morning, everyone. Welcome to our webinar today. So, today we're going to talk to you about IFRSs and the applicability of this IFRSs to the CIMA case studies, especially the MCS and SCS case studies. And with us, we've got Pavan Kumar, a lecturer with Ultimate Access, and my name is Angie De Alves. I'm with Ultimate Access as well, and great to have all of you this Friday morning, especially in the Middle East where it's a holiday, listening to IFRS. I guess it must be quite interesting topic for you guys. And over to you, Pavan. Thank you.
Thank you for the introduction, Anju. Good morning, everyone. And once again, thank you very much for joining. To introduce myself, my name is Pavan Kumar. I'm not a full-time lecturer. I'm a working professional, and lecturing and tutoring is my passion because I believe that helps me in sharing my knowledge with the others and as well as learning from the others as well. So lecturing is a hobby for me and it's a passion for me. So to set the objective of this class or this webinar, the objective of this webinar is not to go through the accounting standards or teach you the accounting standards. What we have done is we have identified certain accounting standards that we felt are relevant to the both MCS and SCS, and we are going to discuss how they can be applied to the both the case studies. And needless to say, we have identified those specific areas in the case studies and put them in the presentation here for your quick reference if you are holding any soft copy or a paper copy with you in your hands of both the case studies or whatever relevant case study it is for you. Having said that, I would also say that the list that we are going to present is not an exhaustive list. If you're able to identify and apply more standards to any of these case studies, please go ahead and do that. So what we thought are relevant here are the intangible assets IAS 38, deferred taxation IAS 12, revenue IAS 18, property, plant and equipment IAS 16, leases IAS 17. I'm assuming and I'm hoping that everyone is able to hear me. Please let me know if nobody is here able to hear me or if anybody is not able to hear you. Okay, great. Now let us discuss a little about ZX on the MCS case study. So overview or an executive summary of this case study is that the furniture industry, the case study is about furniture industry, and in 2016 this furniture industry contributed to $1.6 billion to the country's GDP. And the office furniture market in Korea, which is the country that is mentioned in the case study here, had been under pressure for some years because of the global financial turmoil or the financial crisis. This company is a single shareholder company founded by Mr. Henry Lund in 1983. The mission statement, which is very important, says that the company is committed to offering the very best in office furniture design and excellence in customer service. And when you talk about customer service, and a few mentions in the case study would always be helpful, and it is already mentioned in the case study why they say why they say in their mission statement excellence in customer service is their mission statement. So I'll bring up a few points in the case study which will directly attach to that, though it is not the focus, just for you to understand. And the focus of this company is on producing office furniture products like desks, chairs, and storage cabinets. And they have been doing it innovatively using technology-driven services like 2D and 3D, where we can say they're trying to use virtual imaging here. They are a customer-oriented company. They work closely with its clients throughout each phase of a project. And if you remember, or if you recollect, in the case study, there is a mention at a couple of places that a dedicated project manager is assigned to each and every customer. So this goes in line directly with their mission statement of excellence in customer service. And let us look at some of the key financials here. Year on year, which is over 2015, 2016, the revenue has gone up by 5% if you calculate it yourself. The gross profit has gone down by 8 basis points. I'm not comparing percentages here, I'm comparing the basis points. Percentage versus percentage. Because we should not compare the dollar. When it comes to profit, we should not compare the dollar values. We should compare the percentages. The cost of sales is up by 10%, which is probably contributing towards the reduction in the gross profit, because revenue is up only by 5%, but the cost of sales is up by 10%. With the limited information, we do not have any, we are not able to identify it. Now, operating profit is down by 15 basis points. So the reason for this could be that there is an increase in the selling and distribution costs, which is directly relevant to the revenue, but the revenue has only gone up by 5%. So this is a brief or an executive summary. Mohammed, the IFRS which you tell is applicable for SCS exam? Yes, Mohammed, we will come to that. What we are going to do is we are going to introduce each of them one by one. Let's now talk about the strategic case study here. The luxury watches industry, that's the industry that we are given in the case study. It makes and promotes on the basis of the image or persona that the customer aspires to be. I want to be something or like somebody, so that's why I'm buying a luxury watch. Luxury watchmakers promote themselves through advertising in upmarket magazines and through sponsorships. Two major changes in the technology of watchmaking, which is quartz watches and smart watches. These are the latest trends in the luxury watches industry. And Steelcast itself is again a single shareholder company which was established in 1896 by Mr. Johann Mendel. The mission statement is combines the latest technology using computer numerical control, which is CNC, for certain tasks like drilling and boring, which is mentioned in the case study, and skilled watchmakers for other assembly, which requires manpower or skilled manpower to perform this. Selling price of each watch is a function of the materials that go into the case and the strap. So what kind of material and that goes into the case as well as the strap. If it is a stainless steel case and a leather strap, then probably the price is lesser. If it is the other way around, then it could be higher. And in a certain places in the case study as well, there is a mention that some of these watches are made of pure gold. So when you're talking about a gold watch, then obviously the price of the watch will be higher. And let us look at some key financials. Year on year revenue is up by 18%. Gross profit is up by 6 basis points. Cost of sales is up by 10%. Operating profit is down by 6 basis points, because of an increase in the other operating expenses. The net profit is, however, still at the same level. That is probably because of the drop in the finance costs. So this in a nutshell is about the strategic level case study. Let us first talk about relevance of IFRS 38 for intangible assets for both the case studies. Now, if we talk about ZX context, ZX has a specific it comes up with its own design of furniture. Does it have any patents to this? Does it charge any royalty if somebody is trying to copy it, or if somebody wants to go for a franchisee of or a franchise of ZX's operations? If all these things are true, how are you going to treat them in your books of accounts operationally? How will any of the costs related to the design of furniture, patents and royalty be recorded in your books of accounts? Can't hear? Anyone else having a problem hearing me? Yeah, sure. All right. Now, let us look at it from a steel cast perspective, which is the strategic case study. How can you use IFRS 38 for steel cast? We can probably look at the investment in a strategic project, which is an investment in introduction of smartwatches. Now, Steelcast has its own way of designing and assembling the watches, which is evident from the case study. Now, if Steelcast were to come up with the smartwatches or get into the smartwatches, which is the latest trend now, and in order to stay relevant and survive and thrive in the competition in the industry, then probably at some point in time, Steelcast will also have to venture out into smartwatches. So when they do that, and if they follow their same philosophy of maintaining their own design and patents and royalty, how is it going to be treated? Now, when we have these things in the balance sheet or in the statement of financial position, obviously the value of a company is going to go up because you will have intangible assets, which is your goodwill, patents, and other intellectual property rights. They arise only when you have done something which is accepted by the public in general widely. So that is how you can put IS 38 into context for both these case studies. Is there anything that anybody wants to discuss on this one? All right, let's move on then. So, some relevant material from the case study. ZX's product portfolio. What does it do? From page number 6, this is for the MCS case study. Desking systems. ZX manufactures a wide selection of desking systems, including height adjustable benches and desks designed for individuals, group working, and call center style desking arrangements. ZX also designs and manufactures office reception desks. Now, these sentences that I have highlighted in red here, you should take specific attention, or you should give specific attention to those sentences. It says designs and manufactures. So is this design unique to itself? Is this an innovation or something that ZX has brought up into the market? Seating. Again, ZX designs and manufactures a range of chair designs, including operator seating, executive boardroom chairs, meeting and conference setting, reception setting, and lounge setting. Tables, ZX designs and manufactures a wide range of conference, meeting, and coffee or lounge area tables. Now, if you look at the question here, can ZX identify these manufacturing costs as non-current assets as they would generate future revenues and the costs that can be identified directly? When we talk about design and manufacturing, what I'm essentially trying to say from the IFRS 38 perspective is there is a difference between research and development in according to IFRS 38. During the design phase or the research phase, you cannot identify those costs as an intangible asset. The reason being that you are not sure whether you will be able to generate future revenues at that point in time. Number two is because you cannot ascertain cost definitely to these at that particular stage of designing or researching. But when we talk about development or manufacturing, the design is successful and it has been accepted, or the research is successful and it has been accepted, and then a research has been conducted or a viability study has been conducted which says that there is a potential for sale, and if we put it into production or development, then certain costs are involved. Therefore, any development costs or manufacturing in ZX's context can be or can they be identified as intangible assets under IFRS 38. So this is a question I'm asking you to go back and think. Anybody wants to share anything here? Okay, let's move on then. Now, here is some reading for you about IFRS 38 on intangible assets. From an SCS perspective, I did not find much material which is relevant or can be directly applicable to IFRS 38. However, there is a mention of goodwill and other intangible assets in the statements in the statement of financial position, but there is no mention other than this anywhere. Research and development costs, which I have just discussed about, and the amortization of development costs. Then how do you recognize development costs as an intangible asset? You have to use the pi rate criteria where the probable future economic benefits are there. It will generate future economic benefits. There is an intention to complete and sell. There are technical, financial, and other resources available to complete, and it is able to use and sell the intangible asset, and the technical feasibility of completing is available. And the expenditure related to the development is identifiable reliably and recordable reliably. So these are the criteria based on which you can classify as an asset under IFRS 38. Now let us move on to the next standard that we have brought up here. From a ZX context, we see that there is deferred tax, and the deferred tax has increased year on year. Even in the case of steel cast, there is an increase year on year on the deferred tax, and it is also on the liability side. Now, why does a deferred tax on a liability side come? There is an upward revaluation in the assets, and this point is applicable to both the case studies. There is an upward revaluation in the assets, because of which certain tax liability has come up. That is one reason. And the second reason is accelerated tax allowances. like I said in the beginning, I'm not going to go into the details of what is accelerated tax tolerance and etc. So these could be some of the reasons why the deferred tax can come up on the liability side. Can anyone share any other thoughts that you have on this one? What else could be the reasons why we could have a deferred tax on the liability side? That's right. It's basically the difference between the tax treatment. The difference in the tax treatment of certain expenses in the according to company law and according to tax law. That's right. That's right. For example, if we take the example of depreciation, the depreciation percentages according to company law are different and according to tax law are different. Any other reasons for deferred tax? Changing in depreciation method, carrying value greater than tax base, correct. So this is where our revaluation comes. If you revalue your fixed asset as per recognition, such revalue as income. Yes, correct. Any other thoughts? We have some very good responses here. So you all understand the standard very well. Fantastic. So this is another little bit of a reading material for your quick reference on deferred tax. And here we have put in some taxable temporary differences. What are they? Deductible temporary differences, etc. And the calculation procedure. The deferred tax liability, how does it come up and how do you measure it? So after you are done and when you're trying to, after we are done with webinar and you're trying to relate these to the case study, these readings will help you as a quick reference to understand how it has come up. Let's now talk about revenue recognition, IS 18. In the MCS ZX context, why we have come up with identified IS 18 is because if you look at it, the entire case study says that or gives us an impression that it is a project-based environment. Starting from the scoping till the completion. If you look at page number 5 in your case study, it says that ZX's clients is the heading. ZX works closely with its clients throughout each phase of a project. So we are in a project-based environment where the revenue recognition happens on a milestone basis. Say for example in ZX's case, probably the first milestone where you can invoice the customer is when the design is accepted. And the second milestone is when the prototype is accepted. And the third milestone is when the furniture is delivered. And the final milestone is after the installation services, which are exactly the list given in the or the steps according to the case study for MCS. Now, the other reason why we have why we have identified IS 18 is because it also talks about installation of furniture as a part of the overall service delivery, wherein you have your service pricing coming into the picture. So how are you going to price your service into the excuse me, how are you going to price your service within the overall price that you're quoting to the customer if the service is going to be over a period of time? There is a specific mention of of this in IS 18, and I want you to think about it and go back and link it back to the case study. And of course, the company follows the make to order model, which is what we believe is evident from the case study. Now from this SCS perspective, strategically, the company has highly skilled manpower. And if you look at this, there is a specific mention of this in the manufacturing process where it specifically says, page number 4, the first paragraph towards the last, the final assembly of the movement requires a highly skilled watchmaker to regulate the mechanism so that it tells the time as accurately as possible. Now, how are you charging this manpower into your cost? How are you taking this into the cost of the watch, and how are you pricing it? And a while ago, we also discussed about the significance of the material used in the pricing. The type of the material determines the pricing is exactly the word used in the same page number 4, last para, first sentence. The selling price of each watch is largely a function of the materials that go into the case and the strap. And the entire paragraph describes what do they mean by selling price is a function of material. Now, how are you going to factor this into your revenue, or how are you going to price your product or your watch specifically here to recognize the revenue accordingly? And IS 18 not only just talks about revenue recognition, it also discusses about the associated costs that needs to be booked on a relevant basis. Say for example, if you have completed 50% of a project, you have to identify and record costs which are 50% of the total costs. So that is why we brought in this kind of these points where we talk about manpower, the material and pricing. And here we are talking about project environment and the installation of service, etc. Now, when we talk about steel cast in the strategic case study, there is also a social status factor. Say, for example, if you own a high-end mobile phone like an Apple iPhone, it's a social status factor, right? Now, how are you going to factor this into your pricing, and how are you going to recognize that? So these are certain things that we thought are relevant for recognition in as revenue according to IS 18. Anybody else can come? Is there anything else that you want to add on to this one? IS 15 and IS 11. Okay. How do you think are relevant, Arif? Okay. Great. If you think they are applicable, then please go ahead and explore it. That's right. Milestones are performance obligations. Yes. Yes. We can think about that. You can go back after we finish this webinar. You can try to use it and see whether it fits into it or not. Great. Thank you, Arif. Now, the relevant material from the MCS case study. ZX works closely with its clients throughout each phase of a project. And this is from your page number 5, the first paragraph. It employs dedicated, there's someone here. ZX revenue recognition, will we use the milestone way like project contracts? It is not mentioned in the case study, Yasin, but the way it has been mentioned, I would understand that it is milestone based. Revenue recognition is based on milestones. Mohammed, if watch warranty is for 3 years, can we substantiate some portion from the watch and keep it as an unearned revenue? Maybe. Yes, Muhammad, probably. So that's where I want you all to think and apply as much as you can the relevant case studies to the relevant accounting standards to the case study. And the point that you have brought up here, Mohammed, is very valid. But there is no mention of any warranty or service post. There is no warranty. However, there is a mention in the case study that these watches need regular servicing. Probably the warranty is equivalent to service, or the the pricing includes service as well. Did I answer your question, Mohammed? That's right. So like I shared in the beginning, we are not going to go into the technical details. We are only trying to introduce to you how you can use these um, accounting standards to your relevant case studies. Right. So let's come back to this. It employs dedicated project managers within the design team who liaise with the clients during the design phase to ensure that the final layout and product specification meet their specific needs. The project manager will also liaise with ZX's manufacturing and logistics managers throughout the manufacturing and delivery phases of the project and report back to the client at regular intervals on project progress. So all throughout this case study, it is saying project, project, and project. So that's why, like Yasin said, probably you can also link IFRS 15 to this one. Design and manufacturing activities are also relevant to this because the costs, like I shared before, the relevant costs need to be recognized. And these are mentioned on page number 8 of your case study. And delivery and installation activities also mentioned on the page number 8. So all relevant costs at each stage need to be recognized and recorded accordingly. Relevance to the strategic case study, which is for steel cast. Its watches are designed to be stylish as well as functional, and there is a thriving collector's market for old steel cast watches, especially when they were previously owned by someone famous. And these words are picked up from page number 3 of the case study. Now, why is it relevant? There is a thriving collector's market for old steel cast watches. Does it drive the demand? Of course, from the case study, it says that there is a demand. Can that demand determine the price of your watch? So that is something you have to think about when you are trying to use revenue recognition for the specific case study. Any questions on this one or any other thoughts and inputs from your side? Does anyone want to add more? Okay, in that case, let's move forward. And this is again some reading material, a quick summary for you to apply this standard to the case study. So here we have again added servicing fees included in the price, both for ZX and Steelcast, because there is a installation service in ZX case and there is a servicing post purchase. There is a servicing required every year in a Steelcast scenario. Now let us look at property, plant and equipment. In a ZX context, operationally it has been the manufacturing location has been laid out where they have quicker access to logistics. And from the case study in page number 2, the second para, sorry, the last para, the third para says, in 1992, ZX invested in a new 7.1 million dollar purpose-built manufacturing plant on a new site close to Bartown within easy access to major motorway and rail networks. So quicker access to logistics. Now, how is it relevant to IAS 16? Is this driving the price, or is this determining the value of the property, plant and equipment when you are going for a revaluation exercise? Because if you look at the financials given on, or the statement of financial position given on page number 19 of your case study, the property, plant and equipment has increased in value by about 2.7 million. But there is no mention in the case study where it says the increase in the property, plant and equipment is coming from the purchase of a new plant. This is probably because of a revaluation, which is again determined because of this, the quicker access. The revaluation, the market value of the property is probably higher now. And this also links back to your deferred tax, your IFRS on deferred tax. And ZX has a cost-effective and environment-friendly manufacturing process, which is again mentioned in the case study here. From a strategic case study perspective, Steelcast has strategically aligned its or designed its facility for improved productivity. If you look at page number 4, paragraphs number 3 and 4, it specifically mentions that the workbenches, etc., have been designed ergonomically. The rooms are soundproofed. There is not much of a noise, even though 1,000 people are working there. And there are push trolleys available for the staff to move around small parts and material. So this actually helps or enables you to increase your productivity. And probably you can link this to your world-class manufacturing concept that you have learned in your management level. Secondly, Steelcast has designed or implemented or adopted a technology-driven manufacturing method, which is the CNC method, where the CNC equipment drills the holes in the base plate very accurately, and it can drill up to 53 holes with greater precision. And this is probably giving a competitive advantage to Steelcast. Mohammed, is Steelcast capacity management to increase productivity? That is how I interpret it from the case study. That's my understanding from the case study. That is how I interpreted it. Sorry. Because whenever whenever you are able to comfortably work, normally, and it has already been experimented and recorded, that whenever you are comfortable in a place to work, then the productivity normally increases. And I would like to give an example here, though it's a silly example. In certain countries, like Singapore, the Singapore Post has conducted a test or an experiment where it said that post lunch, all of its employees will get to take a nap for 30 minutes. And when they measured the productivity levels before implementing or before conducting this experiment and after conducting this experiment, they saw a significant differences in the productivity. More installation capital expenditure or increase in plant equipment possible? Yes. There is exactly. There is possibly a greater level of increase in the plant and equipment. Any other points that you want to add? Okay, let's look at the relevance to case study. This is also possible, Muhammad, but there is no mention of it in the case study. This is also possible. And this could come up in your unseen in the question. Now, relevance to the management case study. In 1992, ZX invested in a new $7.1 million purpose-built manufacturing plant on a new site close to Bartown with an easy access to major motorway and railway networks. New production machinery was purchased in 2010, which allowed for a more streamlined and cost-effective production flow as well as a much lower environmental impact. So these are the points that I put in the previous slide. And this is from your page number 2 of your case study, the third paragraph. And ZX's manufacturing plant covers 150,000 square meters and ZX employs over 150 people in total. ZX also operates a showroom located on the site of the manufacturing plant close to Bartown. And this is the extract from the statement of financial position of ZX. Like I mentioned previously, there is an increase of $2.7 million in the property, plant and equipment, but there is no mention in the case study that additional plant or property has been purchased, and this could be a case of revaluation. Now, relevance to steel cast. Steel cast has a single factory in Highlands Highlands East City, and this is from page number 4. I forgot to mention this here. Page number 4 in your case study, manufacturing process. The production process combines the latest technology using CNC for some tasks and skilled watchmakers for others. The mechanism is based on a brass plate that requires 53 holes to be drilled very precisely. Steel cast CNC equipment can drill the holes in base plates more accurately than even the most skilled watchmaker. Other aspects of the assembly are better left to a skilled watchmaker to ensure that the various gears and other parts are fitted together perfectly. The factory is large, employing more than 1,000 people, but is also relatively quiet and peaceful. The CNC machines are located in separate rooms and are individually housed in soundproofed boxes. The watchmakers' workbenches are ergonomically designed and well lit. Parts and work in progress are moved around the factory by pushing trolleys. Now, if you look at the consolidated statement of financial position, it is more or less the same. So this is how you can link IS 16 to your strategic case study. Any inputs on this one? Is there anything else that you want to add on or share? Okay, then let's move on to the next one. So again, there is some reading material for you to quickly refer back and forth to the case study. And again, this material is not exhaustive. I have picked up the major points that I thought are relevant. So Andrea, in steel cast P&L, there are no depreciations. So it is a bit of difficult to understand how many capex they had in 2017. Correct, Andrea. Even I was also feeling a little uncomfortable trying to locate these things. And probably the depreciation is included in the cost of sales, or I'm assuming that they would have included depreciation in cost of sales rather than identifying it as a separate line item. Correct. Possible. Possible, but that information is not available to us. But again, the question comes, where is that 100 in depreciation coming from? Right? So on what basis do we assume that it is 100 in depreciation? Because if you look at the cost of sales, it has not gone up significantly. I understand. I understand. Thank you very much for bringing the point. Now, let us look at the relevance of IS 17 leases to these both case studies. When we talk about ZX's context, in the third page itself, or in the second page itself, it says in the last paragraph, last sentence, ZX also operates a showroom located on the site of the manufacturing plant close to Bar Town. Now, is this showroom also owned, or was it taken on lease? If it was taken on lease, was it a finance lease or an operating lease? That's one question that we have to think about. From a steel cast perspective, the case study says that there is no direct connection with the customer. Steel cast does not have a direct connection with the customer. The sales majorly happen through retail outlets, and the customer only buys their watches from the retail outlets. So this is mentioned in your page number 9, steel cast strategy. Now, for steel cast, there is a potential to go for a forward integration by either setting up its own retail shops, or by buying some of the retail shops which are purchasing from steel cast. Now, when they do this, they have an option to take these retail outlets on lease rather than buying the retail outlets itself. So because that's going to be an experiment for them. On a pilot basis, if they want to try, they can try going for a forward integration by taking retail outlets on the lease. So this is what we thought are relevant to both these case studies. Any inputs or thoughts on this one? There is a huge potential because of the cost price of watches. Correct. That's exactly why we said there is a potential for forward integration, Muhammad. And at a strategic case study level, this is how we have to think. We have to think futuristic. We have to think strategically. Now, relevance to the case study. This is for ZX. And this is again the first para that I have already shared previously. So the red line here also operates a showroom located on the site of the manufacturing plant close to Bartown. There is no mention anywhere in the case study or directly relevant which says this is on lease or bought. Now, if you look at this green point here, my question to all of you is, or the question that we have to ask ourselves is, there is no evidence of the company operating showrooms on a finance lease because the financial statements do not show any lease liability. If it is a finance lease, you have to recognize a finance lease liability, and you have to recognize this as an asset under property, plant and equipment. However, if they were taken on operating lease, the lease payment might have been recorded under administrative expenses or selling and distribution expenses. So this is what we thought is relevant to the management case study. And again, certain reading material for you. For the SCS or strategic case study, we did not directly pick up anything from the case study because the thought that we had was futuristic. So a little more reading material for you on IAS 17. So with this, we have finished this session. Hope you have learned something for it, and it was I think, Anju, this question is for
Correct.
you.
Definitely, we will be sharing this material with you, and I think it was quite informative for both the MCS and SCS case studies. And like you correctly mentioned, Pavan, when it comes to strategic case study, we need to think about the future. The impact on some of the decisions that you take, whether it's going in for a property lease, or are you going to then are you going for a lease, or are you going to purchase it? And also with regards to the new developments of certain IFRSs, so you need to keep those in mind as well when you are launching into a strategy or recommending a strategy. Need to keep that in mind. When it comes to management case study, we are looking at the operational side of it. I think, Pavan, you explained quite well operationally how these IFRSs impact our case study scenario. Any other questions from our attendees? Right? We don't have any other questions, I guess. And thanks a lot to everyone. And for attending this session. We will put a note about IAS 39 financial instruments. So that's Mohammed has requested that. So we will add an additional note to our set of slides and send it to you, send it to everybody. Okay.
Sure.
And with that, we conclude our session today. Thanks a lot, Pavan, and great to have you back here presenting the webinar sessions. And I think Pavan is leading this course for us in 2018, that is IFRS certification and diploma course. So if anyone is interested, please do go ahead and register for this course. Thank you. Thanks a lot. Have a great day. Bye bye.
Thank you, everyone. Thanks for participating. Bye bye.